And I'm just starting it now.
Good afternoon. Welcome to this webinar by Old Square Tax Chambers and Hassans International Law Firm in Gibraltar. My name is Grahame Jackson, and I'm here with my colleague and podcast partner, Harriet Brown of Old Square Tax Chambers. Together, we present the podcast International Tax Bites. And we thought that today we would put together a webinar around the crypto asset reporting framework, which is an extension of the Common Reporting Standard, or CRS, to cover crypto assets, hence the name. So I don't think there's any reason to delay. Harriet, how are you today?
I'm very well, thank you, Grahame. And I understand that the reason that you were maybe a little bit less fluent than usual there is because I didn't interrupt you, which must be a first.
It is, and so thank you for pointing that out. So Harriet's going to take us through the first few slides. I'm going to press the buttons as ever. So let's crack on. Harriet, what is the CARF?
The CARF, other than being a really appalling and appalling shortened form of the name, is a framework for crypto asset reporting, and it comprises two things. You're going to have what's referred to as the CARF framework, and then there are going to be amendments to CRS as well. So it's not a whole separate regime. So there's that, which is a good start. And it comes from the OECD, so from the makers of the Common Reporting Standard. And essentially it's designed to pull in crypto assets. What the OECD say about this is the CARF has been developed in light of the rapid growth of the crypto asset market and pursuant to a mandate from the G20 providing for the reporting of tax information on transactions in crypto assets in a standardized manner, with a view to automatically exchanging such information with the jurisdiction of residence of taxpayers on an annual basis. So for those of you already familiar with CRS, you can basically see that, notwithstanding that it's sort of this framework, it's essentially just making sure that crypto assets are within CRS. And what you've got in the framework is a set of rules and a commentary. So again, like all the other OECD products, in inverted commas. And so the CARF sets out the scope of crypto assets to be covered, and the entities and individuals subject to data collection and reporting requirements, transactions that require reporting, the information that needs to be reported, and due diligence procedure. So the first two important things to identify are what crypto assets are covered, because some aren't, and also who is required to make a report, and that is really key. So CARF only applies, or you'll only be a reporting entity under CARF if you are a reporting crypto asset service provider, or RCASP. And RCASPs are an individual or entity that, as a business, provides a service effectuating exchange transactions for and on behalf of customers, including by acting as a counterparty or as an intermediary to such exchange transactions, or by making available a trading platform. So to pause there for a minute, this primarily is aimed at pulling in crypto asset exchanges. So we've got the definition of exchange transaction, and that is an exchange between relevant crypto assets and fiat currencies, an exchange between one or more forms of relevant crypto assets. So just to pause here a minute, because we're going to get to the good bit, which is all the definitions. But to pause there for a moment, the definition of relevant crypto assets, it does give us a bit of a heads up that not all crypto assets are in scope. Fiat currency is what a technology well, what a Luddite would call proper money, so central bank currencies in their usual paper form, though it is also a defined term, so we'll look at that as well in a minute. These definitions are all found in part 4 of the CARF, in section 4B. And then the other definition that you've got there, so if you remember, I said the two most important things are identifying if you are in scope to make reports and whether or not the crypto assets and or the transaction in question is in scope. So one of the things that's brought into scope here is in fact retail transactions, but that's restricted to retail transactions which are payments for goods or services exceeding $50,000 US. So what we have so far is in scope are these RCASPs, so that's who has to make a report. Then what they have to report on is and the way you find out whether or not you're an RCASP is if you have an exchange transaction. So moving on to the next slide, we've got some more definitions, apparently 2.5. So what's a crypto asset? And we are going to come back to the definition of crypto asset in a minute. The reporting framework takes a similar approach to the layout of CRS with all the definitions at the back, which is always helpful. So this is in section 4A. Crypto asset is digital representation of value that relies on a cryptographically secured distributed ledger or similar technology to validate and secure transactions, which I suspect is a deeply unhelpful definition. The commentary does expand on it a little bit. It tells us that a digital representation of value means that a crypto asset must represent a right to value and that the ownership of or right to such value can be traded or transferred to other individuals or entities in a digital manner. For instance, a token based on cryptography that allows individuals to store value, engage in payments, and that does not represent any claims or rights of membership against a person, rights to property, or other absolute or relative rights is a crypto asset. So to pause there for a moment, one thing that wouldn't be a crypto asset would be, for example, if you had membership that was cryptographically stored, that would not be a crypto asset for the purposes of CARF. It then goes on to say a cryptographic token that represents claims or rights of membership against an individual or entity, rights to property or other absolute relative rights, giving examples of security tokens, derivative contracts, or right to purchase or sell an asset, including a financial asset and a crypto asset at a set date, price, or other predetermined factors, and that can be digitally exchanged for fiat currencies or other crypto assets is a crypto asset. And they then go on to set out some examples. This is in page 47 of the commentary to CARF. I'm not going to go through them, but you should look at those. But it seems to be, certainly at least in the commentary, a central part of this that it's got to be exchangeable digitally for fiat currencies. So you almost get the definition of an exchange transaction colliding with the definition of a crypto asset. Just to stay here a little bit longer, commentary goes on to say that a crypto asset is intended to cover any digital representation of value that relies on a cryptographically secured distributed ledger or similar technology to validate and secure transactions. As such, the term crypto asset encompasses both fungible and non-fungible tokens, and therefore includes non-fungible tokens representing rights to collectibles, games, works of art, physical property, or financial documents that can be traded or transferred to other individuals or entities in a digital manner. So two things that come from this. The first is that financial instruments can be, or cryptographically stored data that represents financial instruments can be a crypto asset. What cannot be a crypto asset is other uses of cryptographic technology, and a couple of examples are given here. cryptography to create a decentralized, immutable record of activities or materials involved in making, storing, shipping, or delivering a product where the record does not convey any ownership rights in such product, or a declarative record of ownership of assets such as real estate ledger or similar agreement where the record does not convey any ownership rights in the asset represented by such record. One thing that we might want to think about here is digital contracts, smart contracts, and where they would fall. And as I always, Grahame is going to start shaking his head at me, smart contracts may well fall into both camps of being crypto assets and not being crypto assets, depending upon their terms. So that's...
Yes, that's right, Harry. It's about whether they transfer value, isn't it? Rather than...
That's it, exactly.
The definition that you read out there for a moment ago about records of supply chains.
Yes.
Distributed ledgers and things like that are being used in supply chain technology quite a lot. Field to fork and tracking parts through complex systems, which is what I think that was reaching for.
Yes, I think that's that. I completely agree with that, and it is important. It is important that those are taken out of scope. And I think you've sort of hit the nail on the head when you say it's about transfer of value, transfer of ownership of the value. So moving on. Sorry, Grahame, were you?
No.
No. Moving on to what a relevant crypto asset is. This is in part 4A2 of the CARF, and essentially it's everything but the things. It's one of these sort of exclusionary definitions. It's everything except these things, and those things primarily are a central bank digital currency, a specified electronic money product that is a payment token with a face value to be used in paying for things, not transferring value, and any crypto asset that the RCASP has determined cannot be used for payment or investment. Now, what that doesn't mean is that the RCASP can just say, oh, well, I don't think this can be used for payment or investment. There's no doubt in my mind that that has to be a reasonable determination. So that doesn't really give you the get out that you might hope for. We get here the definition of fiat currency, which is the official currency of a jurisdiction issued by a jurisdiction or by a designated central bank or monetary authority as represented by physical banknotes. So as I say, real money. And I think Grahame is now going to take you through how this works in a bit more detail.
Apologies for that. So what all this basically boils down to is a series of tests as to whether you are an RCASP or not. And that breaks down into three basic limbs. Is the service carried out as a business? If it is, then is the service carrying out exchanges between relevant crypto assets and fiat, or between different types of crypto assets? And is B being carried out as an intermediary, or as a counterparty, or by providing a trading platform? In most cases, it will be trading platforms, but it's important to remember the intermediary and counterparty elements to this test as well. If you answer yes to all of those things, then you are in scope and you have a reporting obligation, or at least a due diligence obligation, probably better put. So let's move on to see what that amounts to. What does the RCASP have to do to fulfill its obligations? And that is, first of all, it needs to undertake due diligence on all of its customers, its reportable users, however you want to define that, but essentially the people who are doing the exchanges and have reportable items in their scope. And secondly, make the report on its reportable customers. Now, this sentence is quite dramatic. These are onerous tasks, but anybody who's been in the financial services sector since 2016 will realize that CRS was a very complicated thing to implement. And a lot of people within CRS scope and FATCA scope back in 2015, 2016 did not take this as seriously as they possibly should have done, because they believed it would never happen. Nobody would ever manage to get the international community to agree to it. There was lots of conversations around whether Canada would disrupt FATCA, or would Switzerland cooperate with the OECD. However, and people put off implementing this within their organizations longer than they should have done. The reason that I'm talking in these terms is that I don't want crypto service providers to make the same mistake, because it led to weak data in the early stages and patchy implementation across financial institutions and fiduciaries and all the other relevant people. People were still arguing quite late on that it didn't apply to them and things like that. So I think the important thing is to take this seriously and to move forwards.
There was an overwhelming lack of understanding, wasn't there? And I think we're on a two-person crusade to try and make sure that doesn't happen again.
Exactly. And we can learn from the lessons of CRS, because this version of CRS in the CARF is slightly tweaked to make it less incomprehensible to an ordinary person. And I think it's, the lessons can be learned, and everybody should realize this is going to happen. I don't think this requires any great international movements, does it, Harry? It's just about bringing it into local law.
Yes, so I think, yeah, we what we're looking at the moment is getting this finalised sort of within the OECD and with the G20, which is very close. And then, as you say, it will just be a matter of implementation, which is going to require relatively minor tweaks to domestic legislation, because it's almost sort of an add-on, isn't it? It's sort of a fake nose on CRS, really, rather than a whole separate thing.
So, I don't know about any other jurisdiction, but in UK and in the common law jurisdictions, this is the kind of thing that would happen by regulation.
I would have thought so. Statutory instruments, yeah.
Yeah, so it can be done at a moment's notice, almost. But.
Exactly. I mean, you would have thought that with the position we're in, it might be slipped into the UK finance bill, but let's see. And
for those of us those people that are on the line from Gibraltar, it would be in another international tax cooperation set of regs, like we did with FATCA and CRS. Anyway, so we've talked about it has to undertake due diligence on all its customers. What does this mean? Well, the first step is that the RCASP needs to obtain a self-certification form. Now, that is a standard form. If you know what the CRS form looks like, it will look pretty much like that.
Graham, should we just say that this is where you're dealing with an individual?
Where you're dealing with, well, so, yes, but also with entities. The slide is entitled individual due diligence, but the self-certification form is the base point for everything, essentially, when dealing with a customer. It's a standard form. In earlier forms of CRS, this was done manually. It's highly unlikely that an internet-based business like a crypto exchange will be doing it manually, but it must be established for new clients at the establishment of the relationship. And I think Harriet will correct me if I'm wrong, and I'm hoping that she's furiously looking it up. Within 12 months of introduction.
Yeah, I think that's right.
CARF, yeah, for pre-existing clients.
Yes, I was looking it up in my brain, so yeah. But I think it's in there. I think it's written down right in there.
Yeah, and that self-certification form will contain certain data, and that data will be the name, the residential address, the tax, the jurisdictions of tax residence of the individual, and the second stage of that is that of the process is that the RCASP must test the reasonableness of the claims in the self-certification form. Now, that does not mean that the RCASP needs to send out a team of private investigators to check whether you live where you say you live. But what it does mean is that they should compare against the AML KYC data, which they have, which was acquired at the point of establishment of the relationship. All of that data needs to be gathered in accordance with the POCA type rules in the local jurisdiction. And this will need to be checked against the claims on the self-certification form. Now, this is equivalent to the FATCA provisions, where you need to look for what are called indicia, or as any normal human being would call them, an indicator of tax residence. And there's a list in the FATCA regs, isn't there, Harriet, of things like mobile phone numbers, correspondence only addresses, things like that. So what the RCASP needs to do is it needs to confirm, is it reasonable to rely on the details in the self-certification form? So and that may change, what is reasonable may change from jurisdiction to jurisdiction. So if you're in UK and you have a person with an Indian mobile number that's claiming to be resident in the UK and not resident in India, that may be more of an indicator of residence in India than it would be for a person in Gibraltar or Jersey or Guernsey to have a UK mobile number. Now, mobile numbers are not definitive evidence, but you need to be conscious that you're in it's not one rule, one size fits all for this data. So that's just an example. Now, it's very important to remember that where it's the establishment of the relationship rule, so where it's a new client, if the SCF fails the reasonableness test, the regulations say that it must be tested and rejected prior to providing the services. You don't get 12 months to work it out. You can't open the account until you've tested the reasonableness of the data in the SCF. So now, for an entity slightly more complex, for an entity on establishment of the relationship or within 12 months of the rules coming in for pre-existing accounts, you must obtain an entity self-certification form that contains different data around what its categorization is within the CARF framework. And this is where, if it was CRS, we would be talking about active NFEs, passive NFEs, financial institutions, and managed by entity financial institutions. The terms are different in the CARF, but they do they rationalize the CRS structure, but they do basically achieve the same aim.
So the reason we have this aim is because we are looking to what the commentary tells us is that these people are excluded because we have they have a lower risk because of their existing reporting regimes, including under CRS. So, for example, financial institutions are going to be knocked out because they're going to be reporting under CRS. Quite why a managed by investment entity, and for those of you that don't know, this is some sort of entity that is a financial institution by virtue of being managed by another financial institution. In those circumstances, it's not clear to me why that is of greater risk than other financial institutions, but certainly
I have an idea. I have an idea about that.
Okay.
I've never told you before, but a managed by investment entity, which is in a jurisdiction which doesn't have an activated exchange relationship with the jurisdiction of the financial institution, is treated as a passive NFE.
So it's looking to pick those up, but that is much wider than that.
Yeah, but that's the only anomaly about managed by investment entities, which makes them stand out from FIs.
Well, yeah, because I mean, you'd say, well, would they have lower compliance? But that seems than other investment entities. But that would seem to be a non-starter, because 99 times out of 100 or more, the reporting the reporting duty is going to be on the managing investment entity. So you'd expect the same degree of compliance, I suppose. Well, I would anyway.
Yeah, but maybe they're imagining that you would artificially create by interacting across jurisdictions that don't exchange.
Yeah, entirely possible that people would do that. Not
But as we know with rules like this, they will over-engineer everything to the maximum degree to resolve one very minor issue because somebody mentioned it in a meeting very early on.
A nuclear weapon to crack a nut, as it were.
Yeah, exactly. So anyway, so you need to obtain the self-certification form. Again, you need to check the reasonableness of that self-certification form. And inside that self-certification form, there will be a place for the entity to categorize itself either as an excluded person or an active entity. Or I can't remember exactly what the term is for it's just everything else, isn't it? So either an excluded person, active entity, or neither of those. So an excluded person is a quoted or traded entity where the entity is actually traded regularly. An entity which is related to a quoted or traded entity, so a subsidiary. So if Microsoft have a subsidiary, then it will be an excluded person, a government entity, an international organization, or a financial institution other than a managed by investment entity. And what that is, what that class excluded person is the collapsing of the excluded persons and financial institution classes inside the CRS. And then you would determine if it is an active entity, and an active entity is a real business in the sense that it has activity, men loading things into the back of vans, and
a trading entity.
As a trading entity. Thank you very much for the elegant summary there. And I think it's a 50% threshold, isn't it? If 50% of the income comes from active trading, then it is an active entity.
And again, that is very similar, if not identical, to the CRS proper. And again, the way to look at this is because it is a trading entity. If you wanted to hide your money from the taxman or indeed anybody else, whacking it in a trading entity that could lose it all by buying magic beans wouldn't be the best place to hide it. So they represent a lower risk.
Exactly. And they're also filing tax returns wherever they're located. There are very few countries that have no filing whatsoever for active trading entities or no regulation of active trading entities. So if the entity, the customer entity, is neither of those things, then we're into the territory of what would be a passive NFE under standard CRS, and the RCASP needs to identify who are the controlling persons of the entity, which is not an excluded person, which means you need to identify, and it's around ownership and control as defined by the FATF recommendations.
It's the natural persons exercising control over an entity. And that control definition is expanded beyond what we would normally mean to be control. So, for example, in the CARF definition, it says, in the case of a trust, controlling persons means the settlors, the trustees, the protectors, the beneficiaries or classes of beneficiaries, and any other natural persons exercising ultimate effective control over the trust. Now, I think in a general common law sense, we would never say that a settlor exercises control over a trust. In fact, unless they're the trustee as well, it's the exact opposite.
Yeah. So there is a famous sentence in the CRS commentary that says something to the effect of, do not be surprised if controlling persons have no control over the entity. But they've carried on including that problematic definition of the classes of beneficiaries, right? In what you just read out, Harriet?
They have, yes, that's right. Yeah, still got that.
Nobody really knows what it means, but they leave it in there so somebody could take a narrow interpretation or an expansive interpretation and make the reporting much wider. it's a very problematic use of language, that, and I think it really needs to be sorted out by the OECD at some point, because a class is not a person. I mean, that's
Yes, a class of beneficiaries cannot, by definition, be a natural person.
otherwise they would just be a beneficiary. So do we mean that we report on all of them? Do I have to go and explore who everybody is? What happens if the class of beneficiaries is everybody who has ever lived at 25 Acacia Avenue and their grandchildren? Do I need to go and find all of those people?
And of course, because it's certainly in English law, we have this concept that for there to be a valid class, you just need to be able to say at any given point whether or not a particular person is a beneficiary. You're often going to have trusts where it's not possible to do that for the class of beneficiaries.
Yeah, and whilst I understand that they need the net to be as wide as possible, that particular sentence needs refining in a way that allows people to not to reporting financial institutions to not be paralyzed by impractical obligations. Let's put it that way. Anyway, it's my little rant over. So identify the controlling persons, and for an entity, for a company, a controlling person is anybody who owns more than 25% or otherwise has control over the entity. So you can't just have a nominee, the person with the equitable interest. And if nobody is identifiable under that rule, you identify the directors, right, Harriet?
Absolutely.
So the directors, even though they have control of the entity, are not controlling persons unless you can identify no shareholders who are or equity owners. So once you've identified who the controlling persons are, and each entity has a different class of controlling persons, and the RCASP should be aware of. Harriet, I'm doing one of your slides, I apologise.
I was just going to chat message you and say, oh, you stopped doing my slides. This is the second one you've done.
Is it? Oh, okay. You
That's
crack
why I
on
kept
with once
butting
you've
in.
identified the controlling persons. It's this sort of excellent professionalism in webinars that gets the customers in.
Well, I didn't complain about it. I just let you crack on. Right. So what do we do when we've identified controlling persons? We have to assess whether or not they are reportable. And so we're looking for a person who is resident in a controlling person who is resident in a reportable jurisdiction. That is one with which there is an agreement to exchange information under CRS, and which is identified on the list provided by the competent authority. So a quick word here about checking the lists. The OECD has a really useful tool where you can go and search for activated exchange relationships by the name of the jurisdiction. So you can say, stick in BVI, and BVI will, and then it will pop up all of the exchange relationships that BVI has. However, strictly, the definition is that is a relationship identified on the list provided by the competent authority. And that being the case, you do need to check that list, but the OECD tool is a really good starting point for things like for working out whether or not you have a reportable person, so a controlling person in a reportable jurisdiction. So moving on to making the report. For a reportable person, and we've listed some of those there, you're going to have to give a lot of the same details that you would give for CRS anyway. So you're going to need the TIN, the tax identification number, date of birth, place of residence, etc., the financial information. And then we get to what you're going to have to report in relation to the crypto assets. So we've got sort of some of it set out there on the slide. And this is in relation to relevant crypto assets. So some crypto assets won't be relevant crypto assets, and some cryptographically stored data won't be a crypto asset. So this is just for relevant crypto assets. You're going to have to put the full name of the type of crypto asset, record all acquisitions and disposals of relevant crypto assets, against fiat currency. So these exchange transactions. The other type of exchange actions, which is acquisitions and disposals of RCAs against other RCAs, reportable retail payment transactions. Those are the retail transactions that are over $50,000 US, and other transfers of relevant crypto assets to and by the reportable user. So the information that you're going to have to report in relation to these is starting.
I'm going to go through them in more detail on the next couple of slides.
Apologies. And Grahame is going to go through those in more detail on the next slide.
So each of the RCASP needs to identify each crypto asset separately. There will need to be a separate report, and this will all be undoubtedly automated. We are aware of at least one person who's working on something that may be released as open source that would aggregate these things. The first is relatively simple. You need to list acquisitions of relevant crypto assets against fiat currency. So that is some crypto asset being bought for real, in inverted commas, money. And that you need to report the aggregate amount of fiat paid in the period net of transaction fees. So you don't need to list every transaction. Somebody's made 100 transactions with fiat currency, acquired 100 different bits of Bitcoin, then you would just report one aggregate figure over the period, net of transaction fees. The same for disposals, except the other way around. You need to report the aggregate amount of fiat received in the period, net of transaction fees. And then for acquisitions between cryptocurrencies or crypto assets, my apologies, then you report the aggregate fair market value of the relevant crypto assets acquired net of transaction fees. And in reverse, you need to make a report of the aggregate amount of the aggregate fair market value of disposed crypto assets where they're disposed against other crypto assets. So you could end up perfectly possibly with an acquisition of Ethereum paid for with Bitcoin being reported twice. And as Harriet and anybody else who has ever worked on CRS before will understand, there is no fear of double reporting. Double reporting is essentially the name of the game in a lot of cases for CRS. The same £5 note being reported repeatedly because it's owned by different layers in a corporate structure, corporate and trust structure. So that is not something that would rule it out. In fact, I think the commentary specifically says we expect to get double reporting there.
It does, which isn't to say that within organisations one shouldn't avoid it where it is possible to do so, but it is better to double report than to risk infractions.
Yeah, because I mean, one would imagine or one would hope that somewhere inside all the major jurisdictions there will be a big computer that will cut out all the double reporting. But you never know. So A3F talks about the report needs to be made on the aggregate information of transfers which are reportable retail payment transactions. Now that is the customer making any payment for goods or services to the value of over $50,000 US. And in that case, if the RCASP is acting for a merchant, basically, let's say, I don't know, some law firm goes to a big exchange and says, could you facilitate payment for me? And then they receive $50,000 in fees. Then the payer, effectively the client of the law firm, paying $55,000 US, would be treated as a crypto asset user, and a report would need to be made on them as well as on the merchant for the transfers in. So A3G, now this is actually quite a big step. This 50,000 threshold, I think, came in after the consultation document, didn't it, Harry? I think they were originally just trying to capture all retail payments, which would have been huge. But I think that's their aim at some point in the future, to bring that threshold down.
Yes, that certainly seems probable with the path of travel of reporting requirements.
Yeah. So A3G, the RCASP needs to report the fair market value of other transfers. So any other transfer that's not caught by A3F needs to be reported, and that needs to be divided by the transfer type. So that captures things like airdrops and similar, where there may not be a noticeable or the transaction. It's almost like a disconnected transfer. So that needs to be reported there. And then finally, A3I, a report needs to be made by type of crypto asset of the aggregate number of units, aggregate fair market value in fiat of all transfers carried out to any wallet address not known. So this is not, it's not, do you know it isn't attached to a VASP, but that you don't know it is attached to a VASP. Any wallet address not known to be associated with a virtual asset service provider, VASP, or financial institution. And the RCASP, whilst it doesn't need to report the wallet address, and that was in the original draft, it needs to hold the information on the wallet address for no less than 5 years. This is essentially an attempt to track outflows from exchanges, i.e. those who are subject to this report, to this reporting obligation, outflows from those exchanges to anonymous or at least unknown wallets. So yeah, they have to hold the wallet address for no less than 5 years. And it's important to understand that this will catch transfers to a merchant which are exempted by the $50,000 rule above. So that's sort of, there's going to be some sort of interaction there. And that again is mentioned in the commentary that they expect that to happen. So Harriet, what's the timetable for this?
Undecided and undetermined as of yet. So it is, as I think hopefully now you've seen, this is largely a development and add-on to CRS. It feeds into CRS and it draws heavily on the structure of CRS. So for anyone who's used CRS before, it's not too bad. If you haven't used CRS before, then I'm afraid it's quite bad. But because the OECD and the countries dealing with it have used CRS before, final papers are being presented, or I think, in fact, have been presented already this year. And we're going to be looking at domestic legislation coming into force end of 2022, very earliest, but more likely just through the 2023 period. And then first filings are likely to be end of September 23 or end of September 24, again, dependent on implementation. But we may see this in force and requiring filings within a year of today's date. So wherever you are and whatever you're doing, you need to be aware of this, you need to be ready for it, and you need to be ready for it quickly. That even if I mean, you say, oh, a year is a lot of time. A year isn't a lot of time. We know this. So yes, you need to be looking at it now. It would be what I would say in terms of the timetable. So going on to the, what do you need to know now?
To do now.
Oh, what do you need to do now? Yeah, sorry. What do you need to do now? Training from competent people who can read their own slides. Yes, so you need to get some training. Obviously, if you're here today, you've already started doing that, but everyone in your organization is likely to need an awareness of this regime. And some people in your organization are going to need really quite a deep awareness of this, or you're going to need to get outside help, which we'll come on to in a minute. You're going to need to analyze what's going on internally and come to a decision as to whether or not you can manage the burden internally, or whether you need external help, whether you have external help to set up systems that will allow you to manage it, or you are looking for just to outsource it on an ongoing basis, but you need to make a decision about that, and you need to make a decision quickly, because if you're going to outsource, what's going to happen, I suspect, with outsourcing is, to begin with, there are going to be limited people able to take on the outsourcing. And the closer you get to those first reporting deadlines, the busier they're going to be, and the less likely they are going to be able to assist you in the time available. So that's really moved us into resourcing, hasn't it? Where we're looking at, do you want to do it in-house? Do you want to do it outside? Do you want to have help setting up systems to do it in-house and then to do it yourselves? But whatever you're going to do, it needs to be resourced properly. This is a serious matter. We don't necessarily know what the penalties are going to be yet, because those tend to be within the control of domestic legislation. But again, what I would say is CRS penalties are still relatively low, and I would expect the CARF penalties to be similar. I think you can expect to see more emphasis being put on that going forward, dependent on how useful this information is, and particularly with something like crypto, which is much more opaque. I think you can probably expect to see those penalties ramp up quite quickly over the next few years. That would be my guess anyway.
And just to be clear, Harriet, it's a penalty per failure, right? If it follows a CRS form, it's each misreport that is a penalty.
That's right. Yes, I had a client, an unnamed client, and they had they changed their system at a really bad time, and so ended up filing about a day late. And because they were a financial institution that had a lot of managed by investment entities, they thought, oh, well, that's going to be sort of like a 300 quid penalty. It was a 300 odd quid penalty per underlying trust.
Right, okay. So
they can, even with the small penalties, they can ramp up. So if you fail because you can't outsource it and the outsourcer can't get it done in time or whatever, it's not just going to be one penalty for you. It's going to be a penalty for you for every single entity you fail to get a report in on, effectively.
Yeah. Now, there are some pieces of good news. These businesses in scope are by definition tech heavy, and therefore, and all of their customers interact with them over the internet. So they can automate this process in a way that the banks couldn't do, because there is we're talking back in 2016 when there were still quite a few people over the age of 60 and 70 that didn't have a smartphone. But in order to access this service, you must have a computer, you must be using the internet, and therefore this can be done digitally. It has that advantage over the banks, right? Yes,
you would hope. One would hope.
And therefore it can be automated in a way that it couldn't be automated in 2016. So what I'm seeing is what I think the bulk of the human interaction with the process would be the reasonableness test at the level of this self-certification form.
Yes, possibly.
Because the gathering of information will be done as part of the account opening.
Yes, I think the other thing where there's
forward.
going to need to be a degree of independent thought is in entity classification to a degree, and possibly around things like smart contracts, looking at whether or not they constitute a crypto asset. Yeah.
But of the, I believe with very little evidence that the bulk of customers of crypto exchanges are individuals. Because I think it's accounts that people set up to have a go. They don't establish a company to do it, do they?
No, not normally. So it may be that is a lesser problem, but I think the important point to remember is, yes, you can automate a great deal of it, and you should aim to automate a great deal of it, but people still need to know what's going on, and people still need to be able to make independent decisions and recognize where there are entities, individuals, accounts, assets, whatever it is, that an automated system isn't going to be able to deal with without additional human input.
Yeah. So now, Harriet, where could these good people get some training?
Well, it's funny you should ask that, Grahame. Yeah, this is the plug. I'm really sorry. You can certainly get training from us. We're very happy to come in and do training. I'm sure there are other people doing it. I don't know who they are at the moment, but I'm sure that the closer we get, the more people we'll see doing training. But you can certainly come to us, and I'm sure if you Google CARF training, you will find something out there.
We can test systems. We can do presentations for executives. I think one of the big things that I saw with CRS is that people at the top viewing this sort of exercise as getting in the way of them doing their job instead of devoting time to it. The people that I saw implement CRS properly were the ones where the executives engaged.
I think that's right. And by getting on board with it at this stage and getting the implementation right, it should run fairly smoothly with minimal input, but that needs a bigger input now.
Yeah. Instead of what I also saw, which was basically give a copy of the regulations to somebody who you think can't do much damage and leave them in a corner to do it and never engage. That leads to problems.
It does, but to be fair, it's a job that's got that sort of feel to it, isn't it? But no, you shouldn't do that.
We're here to tell you that you shouldn't do that. So I think that's bringing us to a close, isn't it, Harriet? We hope that we've given you an overview of what's required. You'll see on the screen another plug we have. If you're interested in CRS and international tax information exchange regimes in general, we've written a book which you can get from Spiramus Press, and we also present International Tax Bites, the podcast, which you can use the QR code on screen. And we hope that this has made some sense. We are going to take some questions in the chat, and we are sure that you will ask us lots of questions that we don't know the answer to, but we'll give it a go. So, does anybody have any questions? Marco has raised his hand. Marco, do you want to put it in the chat?
Oh, here we go. It's come up in the Q&A, I think.
Oh, it's coming in the Q&A. Right, I'm looking in the wrong place. Hi, all.
Hi, Marco. I'm sure there's more here. I'm sure there's more.
Chat is disabled. Yes, my apologies. The chat's disabled. Please use the Q&A.
So Marco says, I was wondering how the CARF system may impact on future transfer pricing. Any ideas?
I think it does have a transfer pricing sort of link in the fact that lots of things look at fair market value.
Yes, and I think if you're not getting your transfer pricing right, there is the risk that it's going to be revealed through this reporting potentially.
Yeah, but the fact that it's exchange transactions that are 99.9% likely to be with unrelated parties, I think that transfer pricing may not be a massive part of this any more than it is a massive part of CRS.
Yeah, I'd agree with that. I think that's a fair summary. So Tyrone says, if a bank also holds crypto on behalf of clients, does it have to report under the standard CRS regime and this new CRS crypto regime? Now, my answer would be it does not have to report under the crypto regime because it is a financial institution other than a managed by investment entity, and therefore it will be reporting on the crypto as an asset generally under the CRS regime. Would you agree with that, Grahame?
So you're saying it's not an RCASP because it's not carrying out an exchange transaction?
Yeah, it's out of scope. The institution, the bank, is out of scope.
I would just, as ever, as a lawyer, strike a note of caution and just check the facts.
Oh yes, very good point.
Now, would it need to report under the old CRS crypto regime? Does it count as a financial asset for old CRS?
Yes, I've always thought it does.
Harriet thinks it does. There you
What
go.
does that mean, Graham?
I think it represents financial value and it's held in an account with a financial institution, doesn't it? So I think it's as
Okay.
without wanting to preempt any opinion that I might give on it.
Yes, yeah. I mean, I've been fairly public with my view that crypto assets come within the definition of an asset for CRS, and so to that extent are in scope. So the difference here with CARF is really the people and the entities and the type of transactions that it's bringing into scope to make reports.
I think the difference between CARF and CRS is that CARF reports transactions and CRS reports accounts.
Yeah.
Any other questions?
Yeah, hope that answers the question. Anyone else? Just give people a few more seconds to finish typing if they are, but it looks like they're not. So it just leaves us to say, I think, thank you for attending. Thank you for listening. If you've got any questions, you've got our contact details. Do drop us a line.
Yeah, please feel free. Our email addresses are, I think, Harriet's Chambers and my firm will circulate the slides to anybody who has been registered with us. Please have a listen to the podcast, buy the book, and we will see you next time there's some major developments in international tax information exchange, or maybe before.
Who knows?
Goodbye.